pound. Yeah? But of course, that wasn't what happened. And what this means is, what this meant was that many, many markets from the start, from October 1990, when once Britain joined this exchange rate mechanism, they were speculating that the fixed exchange rate at the S-bar was not really the right one. In other words, if you want the long-term sustainable exchange rate, what I've been calling in these lectures the S-bar T plus N, was just substantially different from the actual peg. And because of this, they're saying this was the wrong, they're thinking this is the wrong decision. Sooner or later, these guys will have to devalue. And I'm going to bet this is going to happen. This is going to happen pretty soon. So the bigger the disalignment, the more likely it is that you'll have to pay high interest rates for your domestic assets. And of course, the greater the probability of devaluation, which is, for example, going to depend on the extent of the economic crisis at home, the more likely it is that this term is going to be big, positive and big. Yeah? So this is very important because it shows that with these soft pegs, you commit to a fixed exchange rate, but it's a soft peg in the sense that no one goes to jail if they decide to throw their hands in the air and say, sorry, we're out of this system, we're going to devalue. And because it is a soft peg, and markets know this, they always force the countries to pay higher interest rates. And that difference in interest rates depends crucially on the misalignment, and the probability of the conflict of interest being really, really high. So, as you know, if you're going to fix your exchange rate at a certain value, then you lose your independent monetary policy, your interest rate is fixed, your money supply is fixed, and so this means that if, for whatever reason, people start speculating about the probability of this peg being abandoned, and therefore this term here goes from being zero to being positive, you have to increase interest rates. The increase in interest rates is always bad news for your other objectives in the economy. Our formal model doesn't quite capture that in the way that most models do, in the sense that we have YT here being equal to an autonomous component, and a component that depends on the real exchange rate, and then a component that depends on government expenditure. But a more realistic model, and I briefly mentioned that, I think, in one of the lectures, would have a component here that would say the beta, it depends negatively on interest rates. This was the focus of last year's intermediate macro on monetary policy, and was also the focus of ISFN in your first year. So that's why we're not in this topic using a lot of the AADD framework, because a lot of the action takes place via the negative impact that high interest rates are going to have on demand. So keep this in mind. You can definitely write this in an essay and say, here's why high interest rates are going to be bad. High interest rates reduce demand because they contract investment, and in part they also contract consumption. So let's go back to this. You start with a soft peg, and that is broadly credible. And for simplicity, here I'm assuming that your interest rate is then just equal to the anchor country's interest rate I asterisk. Yeah? In the case of the ERM, this could be about 8% at the beginning, in 1990. Then people start speculating about the probability that this peg is going to be abandoned, and they start requiring a higher return on sterling assets. Why? Because this term becomes positive, and the risk premium can also now become positive. And so, if you're going to keep your peg, remember, you'll have to increase your interest rate. And why is this costly? It's costly because every time you increase your interest rate, you're going to have a negative impact on aggregate demand. And if you're in a recession, as the UK was in 1992, before Black Wednesday, then you're going to make bad things even worse. Is that all right, everyone? And that's why, at some point, you will prefer to abandon the peg, of course, sacrifice a lot of political capital, but at least not wreck the whole economy. Yeah? Now, what happens in terms of the... So I kind of skipped this bit. So what does that mean for the question of are currency crises predictable? Well, with our first generation models, the Mark I model, we said they are, in the sense that bad fiscal policy is taking the economy towards some kind of abyss. And so the speculative attack could happen in a deterministic model of time t. In a more realistic model with uncertainty, it's going to happen with an ever greater probability, but it's just the inevitable consequence of bad fiscal policies and large debts. When it comes to the second generation models, what you see, and that's why there are so many people that don't quite like that speculators, is that with second generation models, there's a big possibility of multiple equilibria and so-called self-fulfilling equilibria. So there is no question that if the fundamentals in the economy are good, then you can have all the George Soroses in the world, they will not succeed in being successful in attacking the currency, and they're just going to lose a lot of money, because what you will have is the central banks just agree to carry on defending the currency, and because the fundamentals are right, this is going to be successful. So there's no question that if fundamentals are right, the crisis will not happen, and so the attack will not be successful. There is no question that, on moving to the other side, to the other extreme, if fundamentals are wrong, so if there's a huge conflict of objectives, keeping the exchange rate constant, as well as trying to use monetary policy to stimulate the economy, there is no question that the attack is going to be successful, and so the devaluation is more or less inevitable. But in between, there's a nebulous region. And it's in this nebulous region when the fundamentals are not either really good or terrible that you get the possibility of multiple equilibria. And so this means that in some cases speculators do not attack the currency and the peg survives. In other cases, they become convinced that the peg is going to be abandoned. They start attacking the currency, that is, selling the currency, requiring higher interest rates on the domestic asset. And because it becomes really costly for the authorities to defend the peg by setting high interest rates and selling foreign exchange reserves, they end up by winning, and therefore become self-fulfilling. So this is the worry of many people when it comes to free capital markets, is the possibility that there's been quite a few currency crises out there that would have been preventable if we didn't have this figure of the speculating, the hedge funds and so on, that really gamble on seeing a big devaluation of the currency as a way to make a lot of money. Yeah? So lots of the bad press comes from this, not so much speculators attacking a currency that is a currency peg that is more or less doomed to fail because the fundamentals are so bad and so weak. Right, illustration of this. So this is going to be quite a lot of repetition for those of you that have seen the documentary. The exchange rate mechanism, the ERM, is basically the precursor of the European Monetary Union. And the basic idea was that after some 2 nice decades of fairly low inflation and high growth in the 50s and 60s, around the mid-70s, there were lots of countries that started seeing inflation rates increasing to double digits. In the UK, at some point in the 70s, inflation reached more than 25%. And that was broadly the case in continental Europe, with the exception of Germany, Western Germany, right? And so Germany, even at that time, it was split, being the strongest economy and being, of course, at the heart of the whole European project with France. There were always the two countries that moved the European project forward. It would make sense to try to stabilize currencies and choose the German currency, the Deutschmark, so DM for Deutschmark, as the anchor currency. The logic, remember, we have accepted the French and the Spaniards and the Italians, and yes, I'm afraid to say the British, that we're rather incompetent at managing our monetary policies, that we keep on having these periods of very high inflation. Germany has managed, throughout these turbulent waters since the demise of Bretton Woods in 1974, to always keep inflation at very low levels. Let's try to peg our currencies to the Deutschmark, and by that import low inflation, a very responsible monetary policy. And that's what they tried to do. And so they went for so-called bands. So you would enter the system by declaring a certain exchange rate, this DS bar. And for the UK, it was approximately 3 Deutschmarks per pound, so that's about 0.33 pounds per Deutschmark. It's just the inverse of that. And so you enter at a particular rate, and then you allow your currency to fluctuate within some very narrow bands. So for most countries, it was plus 2.25%. For the UK, in the beginning, it was plus minus 6%. Yeah? So it's not a hard peg. It's not S has to be equal to that S bar at every single instant in time, but it's throughout the day, make sure that the exchange rate does not move above or below that narrow band of plus minus 2.25% or 6% of that central value S bar. Yeah? And so the UK did that, so this was John Major's pet project, and of course all of his premiership was based on this, on making sure this economic policy was successful. Thatcher had been expelled, had to leave on a few months after this, so 7 weeks, I think, after the October 1990, and this was the situation in the UK versus Germany. So inflation was no longer two digits, but it was still pretty high, 8%, whereas in Germany inflation was only 3%. And of course, interest rates were substantially higher as well, in part because these interest rates were necessary to try to bring inflation down. Yeah? And in terms of growth, Germany had was reuniting in 1990, so we've just celebrated the 25th birthday of the fall of the Berlin Wall, which was a landmark, historical landmark event. And in the UK was effectively walking towards a recession. So this in part was due to the end of the so-called Lawson boom years. House prices, asset prices were falling, interest rates, as you can see, were pretty high, and in general there was just a lack of confidence about the economy, therefore a lack of aggregate demand. A bit more detail about the impact of Germany's reunification. So, of course, most of the Germans lived in the Western Germany, but you still had about 16 million Eastern Germans, and that includes Angela Merkel, the current head of the German
government, sorry. And so all of these Eastern Germans suddenly, overnight, had access to these amazing